Hello everyone, and welcome to today's webinar, Creative Use of Data in Consumer Banking. My name is Silvia Cunell, and I am Qorus Regional Director. As you probably know, Qorus is the largest non-profit association, international, with banks and insurers as members, and we help our members to reinvent themselves, to thrive and to go further, be faster and work together. Collaboration is one of our main strengths. We try to provide a neutral space for best practice sharing and collaboration, and I am pleased today to be able to welcome our speakers from Numberly, Ania Chamsor, Thibaut Meunier, Nicolas Filatif, and Isidis Coste. From Upgrade, Renaud Laplanche, and our chairman at Qorus, Jean-Marc Payol, that it's also head of Global Strategic Partnerships at Allianz. And now I give him the floor. Jean-Marc.
Thank you very much. So I will try to be short. I have the huge responsibility to introduce this session, and I will try to be as disruptive as I like to be. Usually the people who knows me know that I always try to change somewhere the way we approach the topics. So the question I ask myself is why I'm so excited to have this time with you and to share this time with you to hear what Renaud has to say. I'm an old man. I'm not looking like an old man, but I'm an old man. I've started to work in the bank, I don't know, 35 or 36 years ago. I spent 20 years in the bank, and I spent 15 years in the insurance sector. And my first job when I started to work for, at this time, the French bank, a French group, the Banque Populaire Group, as head of marketing, was to launch the first behavioral segmentation. So we started at this time to talk about data and work on the data, work on behavioral segmentation, try to understand what are our clients' behaviors. We worked as well on the semantic segmentation, the way we can find the right wording and so on and so forth. And at the same time, I had the chance to be a child of the telematique in France, which was the origin of the digital move of the world. If you go to the Palo Alto IT museum, you will see that a Minitel is identified as the first, like the stone, the first stone from the Neanderthal human beings. So it's exactly the same. It's the beginning of the digital world. And I had the chance to be embedded at this time and to launch the first online services. We didn't talk about digital app. We are talking about online services at this time. So why I'm so excited now, more than 30 years later, to hear about Renaud and to see what Upgrade has done and how these newcomers on the market are changing the market and addressing in a completely different way the needs of the clients and are disrupting so much the market of the traditional bank and insurance company. So I'm working in insurance company, I work for banks, and I can see that, and I try to inspire myself about what they are doing. So why am I so excited? And I think that I try to summarize what happened during the past 30 years. It's quite simple. We took we decided to have a very simple strategy during years in the bank sector, where we decided to feed the customers with the most product as possible. It was very simple. A client was a customer, and we had to understand better understand the customer to feed him with product. The more product he has, the more loyal he is. No question about what he needs. We try to understand, we try to manage, we try to have data, we try to work on that, behavioral segmentation and so on. But the objective is to increase the business, to increase the number of products, to increase the loyalty of the client, without taking into account what could happen and what could be the competition between us and the other actors on the market. On the other side, we worked a lot on the digitization of the process. The objective was not to make the process better for the client. The objective was very simple, and sorry to be direct, the objective was to decrease the cost and to make sure that we spend less money by asking the client to do the service himself. And it was this great moment of self-service and we're talking about that. We are trying to understand all about that, and we are trying to copy ourselves to put how much responsibility and how much services on the shoulder of our clients. So on one side, equip the client with the maximum of product as possible. On the other side, transform the process to put the responsibility of the service and to give the client responsibility to do it himself. Fine. The impact of that was the following. At the same time, the world had changed. Internet is everywhere. Internet is liquid and internet is everywhere. And these customers start to understand that they can find an information on the market, that they can select, they can compare the different value proposition. And by the way, as soon as they are able to do the things themselves, they start to change their own behaviors. And from my point of view, the conclusion of this big evolution, which was not just for the bank and the insurance sector, it was much more global and much more transversal, was to transform the customer in a client and even in an individual, and to give back the power to this client at the end of the day. And the second impact was to transform their behavior, to create this, what I call digital behavior. What does mean a digital behavior? It doesn't mean to go on internet. It doesn't mean that I use an iPhone or an iPad or a laptop. It means that I want simple, fast, transparent, lean, user-friendly, and personalized experience when I do something. When I go to a restaurant, when I go online to buy something, when I go to my bank, when I go to my insurance, whenever it is, I want to have a simple, fast, transparent, lean, user-friendly, and personalized experience. It has changed completely the rule of the games. The power is now into the hands of the client, meaning that it has opened enormous opportunities to newcomers who are starting by being digital by default and who has understood from the beginning that the client has the key, the client has the power, and that we have to go from push to pull. And I think that it's exactly why I'm so excited to hear what Renaud has to say. And based on that, of course, even if we were using data before, the data are becoming more and more important, because if you want to be digital by default, you need by default to understand what are the client needs. You need by default to build a value proposition which will be personalized and adapted to the need of the client. And you need by default to build the processes which will be adapted to this simple, fast, transparent, lean, user-friendly, and personalized approach. We need to build somewhere some tailor-made industrialized solution. And this is exactly, I think, what these neobanks, this insurtech, this fintech are trying to do by using this data, by building this IT system much more flexible and much more personalized to the need of the client, to create this new approach, this new value proposition, which will be digital by default, meaning adapted to the digital world in which we are living, meaning that they will accompany and they will do this digital revolution we are living currently. That's why I'm so excited, despite the fact that I worked on data for years, and that's why I think that it will be a great moment to spend together to hear what Renaud has to say. So thanks for the time. I try to be as fast as possible, as digital as possible, simple, fast, transparent, user-friendly. Renaud, I don't know if Nicolas you want to take the lead, but this is what I had to say. Thank you for your attention, and now let's just listen to the very interesting thing you have to say.
Thank you, Jean-Marc. I hope you can all hear me. I'm Thibaut Munier. It's a pleasure to introduce the session, or reintroduce it. Actually, my job is very easy. It's to introduce my friend Renaud Laplanche, live from San Francisco today. Thank you so much, Renaud. It's very early on in the morning for you. We know it. We're extremely thankful for that. We've known you, Renaud, for years with Isolis, and it's always been a dream to invite you to one of our webinars. So here we are with Qorus. We are also lucky to have you with us today. Welcome, Renaud. Today, we'll have the honor to present this live session with Anya Champsor, digital marketing expert based in New York, Nicolas Filatiev, managing director based in Brussels, and Isolis, my co-founder in Paris. Renaud, very quickly to introduce you. I don't know where to start. You're a lawyer, you're a banker, you're an entrepreneur, but no, in fact, you are a sailor who ended up founding a lending club and then upgrade. My kids would probably define you as a Mike Ross from Netflix show Suits, except you did graduate from LBS. You love competition. You won the French sailing championships. And since April 2015, with your co-skipper, Ryan Braymeyer, you have held so many records, from Newport to Bermuda, from Cowes to Dinard, and of course the Transpac from Long Beach to Oahu, Hawaii. But who cares? For me, you will always be the one, Renaud, who made me sail under the Golden Gate Bridge at the speed of 30 knots. You are unique, and thanks you so much for being with us. We're so lucky to have you with us today for an hour. Welcome, Renaud, and welcome everyone. Maybe, Renaud, to kick off this, can you tell us a little bit about this incredible journey at Upgrade? How did you get up there?
Thank you, Thibaut. Yeah, great to be here. Let's start with how it all started at Upgrade. So it was 2016. Myself and my co-founders really were looking at a sort of fintech space. We had All Left Lending Club, which I co-founded and ran for 10 years and took public. And we were thinking, okay, how can we use everything we learned over the last 10 years to make it more exciting for everyone. And we thought of Upgrade really as a way to provide sort of better banking solutions to consumers. I think we wanted to do something pretty broad in scope and craft products and solutions that have the broadest appeal to the largest swath of the population. So unlike a lot of fintech and neobanks, we didn't necessarily target a specific sort of underbanked part of the population or younger consumers who sort of didn't grow up going to a bank. We said, okay, let's make really a sort of neobank for everyone and target sort of mainstream consumers who do have a banking relationship, but we believe we can create more value, deliver more value, and better experience than what they get from their traditional bank. And so a way to achieve that, sort of more value and a better experience, is really for product innovation. And so, okay, let's sort of rethink loans, credit cards, banking in a way, to the point that was made earlier, that's very consumer-centric, and not necessarily consumer-centric in terms of what consumers tell us they want, but on rather what we think is best for them. And it's always a challenge. It's more for supply-driven innovation and demand-driven innovation, which is not uncommon in a pretty sort of technical space like financial services. It's really hard for consumers to know exactly what they want and dream up new financial products. And so
thank you, Renaud. Yeah, thank you so much. Maybe before we continue with the different questions we were thinking of, Anya, you want to quickly take us through consumer finance in the US?
Absolutely, thank you, Thibaut. We thought it would be helpful to have just a quick introduction to give some context about the US consumer credit landscape. So broadly speaking, consumer credit refers to any type of loan given to individual consumers, such as mortgages or auto loans. How credit usually refers to, and the definition that we'll be considering during this webinar, is specifically unsecured loans taken on for personal consumption. So credit cards or personal loans. Unsecured loan means that there is no asset or collateral attached to the reimbursement of the debt. Therefore, the interest rate for these is usually higher because the lenders or the banking institutions are taking more risks. These loans can be closed, where the consumer reimburses the debt through monthly payments over a predetermined period of time, or they can be open-ended, where the consumer must reimburse a minimum amount and the associated interest before a specific date. So that's the case for credit cards, for instance, and we want to talk about that a little bit. It's a type of open-ended unsecured loan that is widely popular in the United States. 70% of the US population has a credit card, and 34% of Americans have 3 or more. And credit cards are really interesting and important, not just because they're really popular, but because they are at the root of an individual credit score. And we'll come back to the concept of the credit score a little later in the webinar, but basically it's the result of a somewhat nebulous formula to determine a consumer's ability to reimburse their debt. And it's extremely important in the American economy. So it determines someone's ability to rent certain apartments, buy certain cars, but also the rate at which someone will be able to borrow money. And that is what's on this slide. As you can see, loan interest rates can vary tremendously based on your credit score. So that actually leads us into the first theme of our webinar, which is macro trends.
Thank you so much, Anya. So indeed, let's set the stage with the macro trends. We have this context of major geopolitical instability, of energy pricings that have been soaring. As a consequence, the inflation is going up. And in order to try counter that inflation, we've seen the central banks raise the basis rates in order to increase the cost of loan, for instance, and thereby limit the impact of inflation. So according to you, Renaud, what's the impact of all of this turmoil and this current rate hike on the fintech ecosystem? And then maybe more specifically on loans and current accounts, which are key products for you?
Yeah, and then maybe before I answer that question, I can just give you a quick rundown on Upgrade, which we interrupted earlier. But just quickly, so what I was saying is again trying to push a lot of product innovation onto consumers in a way that is sort of helpful to the consumers of long-term credit health and financial health, and really help consumers make good financial decisions, really understand their financial situation, and get into products that are fundamentally good for consumers in the long run. So one example of that is Upgrade Card, which is our credit card. That's our flagship product. I think the point was made earlier that credit cards are like very material in a consumer's financial life in the US. But they're also pretty bad consumer product in the sense that they're very high interest rates, they have a lot of fees, and they are sort of designed to keep consumers in debt as long as possible, right? It's a revolving debt. You can make the monthly minimum payment on the card, and if that's the only payment you make, it's going to take you 25 years to pay off the balance, because a monthly minimum payment mostly pays interest and a very tiny portion of the principal. So a lot of American families fall into sort of revolving credit card debt. There's about $1 trillion in credit card debt in the US, which is $8,000 for every American family. So what we decided to do with Upgrade Card was really to deliver a more responsible credit card. And so the way it works, it was great to see this earlier explanation about closed-end and open-ended. The way it works, it's really a hybrid between the two. So it's a credit card that lets you make payments, access a line of credit, but the balance at the end of each month turns into an installment loan, which is closed-end. Which means that we bring sort of forced discipline onto the user. And instead of getting more and more into debt every month, customers are able to pay down their debt every month, save on the cost of interest because the balance comes down every month. The rate is typically lower, and hopefully sleep better at night, knowing they're not getting further into debt every month. So I think that's a kind of product innovation that's fundamentally good for consumers and isn't necessarily more profitable to us. But we think over time, as of consumers will realize how good our products are for their future financial health and reward us for it and come back for more. So it's a little bit of a sort of leap of faith of doing more consumer-friendly products that we believe in the long term are also good for business. So that being said, going back to the question on interest rates. So I think interest rates are very impactful for fintech and banks, obviously in a number of ways. One, it makes capital more expensive. So since we deliver credit, this expensive capital sort of makes it harder for sort of all our sources of capital to extend loans or to buy loans from us. We're fintech, we're very capital light, we don't have our own balance sheet, so we basically sell loans and card receivables to banks and asset managers. And so clearly the higher rates makes it a little bit harder. That being said, on that side of the business, we also use a lot of product innovation. We created a product called Boomerang, which consists of us collecting deposits through a savings account, sending these deposits to banks and credit unions, for banks and credit unions to use that capital to buy loans from us, hence the sort of Boomerang shape. And then so that has been tremendously helpful. So a lot of other sort of credit fintech have having hard time funding loans. We've been able to keep running by, again, raising deposits ourselves, using our national brand and online presence to raise deposits, and sweeping these deposits overnight to our bank partners. We work with 200 banks and credit unions and get these deposits back in the form of loans, essentially matching assets and liabilities, but not on our own balance sheet, but rather at a distributed in a distributed way at the network level, using 200 different banks and credit unions. So that process really helped us cope with higher interest rates. The other impact of interest rates is obviously slowing down the economy, potentially raising credit risks. So we've tightened our credit standards quite a bit in anticipation of a slower economy and higher unemployment.
Super interesting. Thank you very much. It's interesting to see that it's also the product phase and the products combination that you just described, which is making the change and not only being, of course, a new fintech in a context which is super difficult. And if we look at the customers now, do you see changes in the consumer behavior, be it based on the context, but also based on the new products that you're deploying to the market, like you just explained?
Yeah, no, for sure. And I mean, so far, inflation and the beginning of an economic slowdown has had very bifurcated impact on our customer base. I mean, we're very mainstream, so we have customers who earn $250,000 a year, and others who earn $40,000 a year. So very, very different impact there. I think for sort of mass affluent customers, they've continued spending like nothing happened. Obviously, for sort of lower income part of our base, they're feeling the pinch of inflation a lot more. So for them, we're really trying to sort of design products that are helpful. So we recently launched a sort of new rewards program for these particular customers that is designed to help them with sort of core expenses, so gas, groceries, sort of basic healthcare, things that are sort of basic necessity, and where sort of inflation has taken away sort of 6 to 8% of their purchasing power. So we're trying to give them back some purchasing power as much as we can. We have a 3% cashback rewards that's already sort of taking care of half of the problem. And additional deals with partners that can give them up to 10% cashback with some partnerships with merchants. So all that really designed to sort of offset some of the impact of inflation.
Thank you very much, Renaud. And talking about the customer experience, as you just said, that you try to make fluid and seamless, even in regarding the inflation point. This is we can talk about it, the experience toolkit, the critical role of customer experience, of course. And regarding that, I think that you have different obsessions, let's say like that, but the seamless one is very important to you regarding bots and regarding customers, I think. So how does your app experience compare with traditional banks? How you will describe that?
Yeah, it's interesting. So fintech initially was a lot about sort of frictionless payments, for example, and a lot of simpler experience in a lot of like everyday tasks, like time saving, and then getting access to these like younger consumers who are also digitally native and aren't used to sort of waiting in line at a bank teller. I think for credit products, it's a bit different. So obviously, frictionless access is important, but it's not really the sort of key factor of success. I think at the end of the day, for us, delivering value is more important. If you take a $20,000 personal loan, it's not something you're going to do every day, right? You might get that kind of loan every 2 or 3 years. So whether you spend 10 minutes or 5 minutes, if it's once every 3 years, it's not all that a big deal. And what matters a lot more is if that loan is going to cost you $5,000 in interest over the life of the loan, or $2,000, right? So I think for less frequent transactions, like credit decisions that have a sort of more meaningful sort of financial impact, we think a lot more about, okay, how can we lower interest rates? How can this make this product a no-fee product? How can we sort of help if in circumstances where our customers sort of loses their job and can't make 2 or 3 payments, and how can we help them catch up over the life of the loan? So we think a lot more about this. You can call it experience too, because at the end of the day, it's part of an overall experience. But it's not necessarily experience in terms of how do I get through the funnel and how do I sort of save a few seconds of that transaction. I think it's more about like holistically thinking about how much value we can deliver to our customers.
Yeah, product more than UX at the end of the day. And regarding that, you would say, what is your vision on the evolution of neobanks, you would say?
Yeah, so I think neobanks are sort of really well positioned to deliver sort of a lot of value to consumers, right? Because we get access to bank account information. We have tremendous amount of knowledge about our customers. We know pretty much everything that's happening in their financial life. We have lots of access to transactional data, credit data. And I think we're uniquely situated to sort of be helpful to our customers, including for things like that go beyond sort of banking and credit. I think everybody's sort of racing to deliver a super app type of experience that also includes sort of e-commerce, payments, credit. I mean, basically insurance, everything you need in your life. And at the end of the day, I think the apps or the companies that are the best positioned to deliver that super app value and experience are certainly financial companies, because we have access to so much data and are like so well positioned to be sort of impactful in our customers' life by delivering sort of lower cost credit, more frictionless commerce and payment. And so I think a lot of the space is going to go into that direction of going to beyond financial services and bleeding onto sort of e-commerce, insurance, and other aspects of financial services.
Very clear. And if we go further on that, if we want to look at differences, for example, how do you see Upgrade as different from N26, for example, or Revolut? On which side you would say it's different? Because you present us quite a lot of different area of differentiations. But for you, what are the most important regarding them?
Yeah, so I think two key differences are sort of target customers. I think both N26 and Revolut started with at least a younger consumer. Our customers are 40-year-old on average. They earn $100,000 individual income. Their credit score is 700, which is about the sort of national average. So they're very average in a lot of ways, but not particularly young. Well, I'd love to be 40-year-old. So that's one difference. So we're really sort of going very mainstream, targeting broad swath of the population. And the second that sort of goes hand in hand with the mainstream focus is we're sort of credit-based as opposed to payment-based. So I think the monetization strategy for the business model and I think most of the value we deliver to our customers is really based on credit products. And it's partially because we're based in the US and then consumer credit is bigger here. Partially also for just like practical reasons, just coming from Lending Club, credit is what we knew best. And so we started with what we knew and then expanded from there. I think the sort of credit-based models tend to work better in the sense that, I mean, the monetization is a lot greater, right? In the US, if you look at company like Upgrade or company like Chime, so Chime earns about 1.4% of every transaction through just debit interchange. We earn 7% of every transaction through sort of credit by sort of setting the credit balance to banks and credit unions at a markup, by earning credit interchange. So the fee paid by merchant is higher on a credit card than a debit card. So all these little differences make sort of credit-based neobanks typically more profitable. So we've been profitable for a couple of years. And if you look at Nubank in Brazil, so same model, credit-based, also profitable. While a lot of the sort of debit payment-based neobanks are having harder times of getting to profit.
Thank you, Renaud. It's already time for chapter 3 in this discussion about the priceless value of customer data. So, of course, we have this question for you about the value of data because, as we all know, financial services, as we can see here in this BCG study, have a structural advantage, like maybe retail, regarding the direct access via transactions, regarding their ability to collect first-party data and obviously activate first-party data. So, Renaud, can you maybe explain how you take into account at Upgrade customer data in your scoring?
Yeah, so in a number of ways. So we have like several types of data, right? There's sort of behavioral data, so data we collect as customers apply for a loan, and then how they use the loan or the credit card or debit card. So obviously with card product, it's more sort of repetitive use. So we get more frequent data. There's sort of all the data we can collect about our customers. So directly, so you talked about the credit score. I think at the time of application, we collect a credit report, which is so very comprehensive. It does include the credit score, but it also includes the entire credit history of consumers, everything they've done over the last 20 years in terms of not only loans they got, but payment history. A lot of the credit bureaus, so the organizations in charge of collecting that credit history, or have also expanded their sort of statistical models and their sort of data coverage to include things like bill payments and rent payments, things that aren't necessarily credits, but do provide a good insight into sort of how responsible that person has been to make payments on time. And then the third source of data, so behavioral collection through credit agencies and other sources of data. So the third source is really just asking users. So all the data they sort of provide to us at the time of the application. So obviously to sort of deliver a pretty seamless application experience, we tend to minimize how much we ask and try to maximize sort of how much we infer from sort of past behavior. But clearly, there's like 3 types of data sources. or super helpful in scoring, then we sort of put all that into our statistical model and machine learning algorithms, and really sort of crank up the sort of model output that tells us sort of what the likelihood for a consumer to perform on their credit. And then there are sort of a number of other sort of statistical models that help us make sort of ongoing decisions. So, for example, when someone is late on the payment, we run a model that tells us, okay, what's the likelihood for that person to eventually make that payment. And so that depends on whether they're late on sort of other with other credit providers or just us. It depends on their sort of employment situation, depends on macroeconomic trends, which gives us the likelihood for that person to find a new job. It depends on the type of job and position. So all that is taken into account then to make a decision on, okay, that account is late, what do we do? Do we sort of help lower the payment so that they have a shot at sort of staying on track? Or is it more of a disparate case, and then we can settle for, if we determine there's sort of 15% chance that person will eventually make a payment, and we can settle for 20%, we'll take that settlement. So all these decisions, whether it's sort of granting credit in the first place, or the amount of credit we give to someone, or servicing and collections, all these decisions for the customer's life and the loan life are really informed by some data and statistical models.
Yeah, thank you, Renaud. And you say that you're trying to ask not a lot of questions to your clients, need to infer some data. So in these data points, what is your take on the contribution of social networks to consumer credit? Because it generates a lot of data. So what's your think about that?
Yeah, so yeah, it's sort of like double-edged sword. There is a lot of data out there. Most of it is illegal for us to use, unfortunately. We really can't use most of the data in social networks. We can use it for targeting purposes, which is like super helpful, right? So we know someone's interest and a lot of like demographic information. So that's helpful in terms of understanding customers' of life decisions and how we can be the most helpful to them. It's typically not sort of information we can use to grant credit. It's a shame in a way, because a lot of the sort of social network data is correlates well with credit performance. But I think the banking authorities in the US are, I think, legitimately worried about where this can go in terms of privacy, in terms of sort of impact on protected populations. So we really can't use it to make credit decisions. We can use a lot of data to make fraud risk based decisions, but not credit decision per se.
Very clear on what you're talking about at some point is really what we can call the privacy dilemma, and on that, what's your view on the availability of public-private data sources? What's your vision on that?
Yeah, so it's really interesting. I mean, there's been sort of, I think, more and more sort of privacy protection regulations in the US, including specific regulation in California that is also sort of driving, like raising the bar nationwide in terms of privacy protection. And when we ask our customers and really sort of help them understand the impact of privacy, so it's sort of there's a superficial level of, hey, would you like your privacy to be better protected? Sure. Yeah, yes. It's hard to answer no to that question. But when you start putting sort of trade-offs in front of consumers and say, okay, would you rather us know when you're losing your job so that we can lower your payment? Yes, I would. Or would you rather us know that you have another loan at another bank, another lender, where you're paying sort of 200 basis point higher interest rate, so that we can send you an offer to refinance that loan? Oh yes, that would be great. So would you like us to tell you that so you're paying too much on your car insurance, or that hey, your car hasn't depreciated as much as we thought initially, so there's more value in your car, so you can get an extra $1,000 in credit against the value in your car? Yes, I would love to know that. So when you sort of start putting privacy in the context of what that information can do for you, then you start getting very different answers. So I tend to think that some of that privacy protection might be misplaced and is not always in the best interest of consumers. And I find that a lot of the sort of public discourse on privacy tend to be pretty superficial and not necessarily show the sort of pros and cons.
Thank you. Very, very clear. And now we can, I think, go to the fourth chapter, which is a very, very interesting one. The journey towards data-driven performance. And perhaps, Nicolas, you can just introduce that.
Sure. So if we look at how we leverage data in order to improve the performance of marketing, there are a number of frameworks that you can use, and this is one of them, but of course there are many of them. And that framework we typically use at Numberly for either banking clients, but also in other industries. And the purpose is to help companies understand how they will make most progress, be it on CRM side, be it on the media side, or be it through the combination of both. And typically we find out that there are 5 variables that have the highest impact. One is about targeting. How much do you know your data, and how refined are you in the way you activate an email or a message? Second one is content. The third one is channel. Do you have a limited number of channels or many of them? And even more importantly, are you able to activate throughout channels in a coherent way and use the data or the reaction data or the engagement data from a customer from one channel and embed that knowledge to activate better on the second one? The fourth variable is about measurements. How far do you measure? How accurate is your measurement? And are you able to measure the incremental performance of an activation? And then the fifth one is about process management and team. And what we see overall, it's about the weakest link, meaning some companies are very good in one of these variables or 2 of these variables, but if they're lagging behind on another one, then the overall articulation is missing its impact. That's basically how we see it, meaning it's really important. Of course, everyone wants to be good on all of these variables, but you cannot afford to be extremely advanced on one of them and lagging behind on the other one. It doesn't make sense. Now, if we move forward to customer journeys, on the right-hand side, you have one typical example, but again, there are many, of a customer going throughout online touchpoints and offline touchpoints. And you can go to your branch, you can call your advisor, you can go to your banking on the website or on the app, you can be exposed to a media banner, and so on and so on. But of course, it's important to remember that it's the customer who's choosing which touchpoint he or she is using and in what order. So you have to be able to answer any question or address any problem on all of the channels, but it's always the customer who will choose which are his or her preferred channels and in what order they will use them. And what you look at the analysis that was done by McKinsey and Company on banking specifically, what they say, and we fully agree with them, is that most banks are good at focusing on the purchasing moment, the blue dots that you see on the slide. But being accurate and relevant before the purchase is more important, because it allows you to come before your competitors, of course, but it also allows you to be more relevant. And many banks have been saying, we don't want to provide mortgages to customers. We want to help clients get to be able to buy a home. And in that context, you're not about finding the customer when he wants a loan. You're about finding the customer when he's trying to find for his dream house or flat. And that's articulating data way before the purchasing moment. And that's what makes, I think, the digital marketing more performing. So based on these elements or others that you may deem relevant, Renaud, what do you think the main KPIs for your company are?
Yeah, so yeah, a number of KPIs, and to your point, I mean, it's a jigsaw puzzle, and there are probably like hundreds of things we measure on any given day. They tend to be mostly about volume, performance, and customer satisfaction, and because these two really sort of drive the business. Volume drives a sort of day-to-day monthly performance, and customer satisfaction, we believe, drives future product improvement and adoption and loyalty. So the long term of the company. And so I think there are just like some super interesting sort of data nuggets that we find in our KPI. So on the volume side, we sort of really sort of follow payments very, very closely. So what our customers are using the cards for, how frequently they use the card, the average ticket item, and also again through all the information we get through the credit report, we can compare sort of how much they're using a upgrade card compared to other cards they might have, and that helps us understand if we're sort of what we call top of wallet, even though it's no longer always in a physical wallet, but the sort of the card that comes first out of the wallet, their sort of preferred card in a way. And so on. So the good news is upgrade card is top of wallet for our customers, and it gets there very quickly within sort of 3 months. It really sort of supplants all sort of legacy cards. But the more interestingly, what we found sort of going through the data, for example, is we found that very often sort of customers used a credit card for the wrong reason, right? So the credit cards for things that have nothing to do with credit, that they should be paying out of their current account, but they use a credit card to earn sort of cashback rewards and points. And the sort of negative impact of that, not so much with upgrade card, but with credit cards in general, is sometimes people use a credit card to earn rewards, but then they don't make the minimum payment, or they make just the minimum payment, and they sort of start accumulating debt inadvertently just because they use the wrong card, they use credit instead of debit. So that led to the genesis of a new product we launched last summer called One Card, which is a card that actually is both a debit and a credit card, and you can sort of go to the app and toggle debit or credit, or we call it pay now, pay later, and that really sort of trains consumers to use sort of debit for everyday expenses or sort of recurring expenses where you shouldn't sort of borrow for, and credit only for those expenses that are sort of more occasional, more extraordinary, larger amounts where it's okay to spread that payment over a few months. So we think it's a really good example of really sort of product innovation that's good for consumers, because it sort of educates consumers. You can set a threshold. You can say, hey, if it's less than $200, so debit that directly from my bank account. If it's more than 200, spread the payment over 6 months. So it really sort of helps consumers make sort of good, sound financial decisions on how to sort of manage their credit and their personal finance, and at the same time sort of give them better rewards.
Yeah, and a lot of people are talking about frugality, or responsibility at least, and perhaps it's a tool that you give in the end. And gives you as well a KPI and the ability to leverage well this kind of tool by your consumers.
That's right.
Yeah. You are very innovative regarding product, but as well regarding channels and content you're using. I mean, you've had some experiences on TV streaming experience. What have you learned with that? Can you tell us?
Yeah, what was really interesting was a sort of unexpected success. I mean, our team is sort of with performance marketing team. It's hard for me to get them to do anything that they can't sort of immediately measure in great detail. So TV was a bit of a stretch. I think we found a sort of okay way to measure the impact, so just by essentially measuring the sort of inflow of applications for cards and loans for the particular product we were advertising during the spot, during a 15 or 30-second spot, and within sort of 2 minutes after that spot. So we were able to measure really sort of interesting lift on number of applications at a cost that, again, surprisingly works well for us, even using that pretty narrow definition of the impact. Obviously, sort of TV and streaming has a broader impact in terms of brand awareness and overall lift. But even sort of looking specifically at performance marketing and sort of direct impact during the spot and within 2 minutes, we were able to see a really nice lift with a customer acquisition cost that works well for us. And I think the learning there is, I think what tends to work well for us is when we get the ability to sort of convey more about the product benefits. So a lot of advertising online, you're limited by sort of number of characters. You can't really sort of tell a story. Or if you're on Credit Karma, you have a choice between 5 different credit cards and whatever, so 150 characters to explain the difference between an upgrade card and something else. And I mean, for us, the difference is it's a more responsible product. Responsibility is not a great selling point. So we sort of try to use more derivatives of that. So I mean, it's more responsible also because it saves you on the cost of interest. So it makes it a lower cost card. The lower cost is a more direct benefit, and the responsibility and the benefit of that responsibility on your long-term financial future is more of a sort of discovered benefit over time. So there are different ways to use these different spaces, but on TV, what we find is, I mean, we really control the message. We have the audience for 15 or even 30 seconds. That helps us pack a lot more of the message into that spot. We also got really nice sort of creative. It's a debt donkey. So it's literally a donkey sort of carrying a lot of debt and crumbling under the weight of all that debt. So in the first episode, the donkey was in a furniture store. In the second, it was in a bike shop. So pretty expensive items that you might not want to use a traditional credit card for, because then you're going to crumble even more under the weight of the debt. So we sort of learned a lot with these experiments. We also learned about sort of donkeys, which are pretty moody animals. So we had to fire the initial donkey, replace him with a new one. And actually, the new one is under long-term contract. We signed him up for 3 years because it was so hard to find the right donkey. And the casting for that was pretty entertaining.
Pretty cool, I imagine. We are very lucky because we have some minutes left, and we can have some questions from people we are sharing this moment with. So please don't hesitate. I will start perhaps with the first one, which is hello, the products you describe do not exist in Europe, and despite regulation being different, some of these elements could be deployed in Europe. Why do you think it's not been the case so far?
Yeah, so it's a really interesting point about financial services. It's hard to create a global platform, right? It's you can imagine an international platform with slightly different product being adapted to different countries. I think payments are a lot more homogeneous, so it was sort of easier for PayPal to go like almost global. I think for credit-based financial services, there are enough differences in regulation, in consumer behavior, in just how the banking system operates, that it's really a country-by-country approach, which makes our job harder when we think about international expansion. But I think in every country there are problems to solve. The problems are a bit different and they require different product innovation. But I think there are opportunities in every country.
Yeah, I'm sure of that. Another question is, do you see Google, Apple, or Amazon as potential competitors in the future?
Potentially. So I think generally tech companies have been better at entering the payment space rather than credit. I think probably the largest attempt is Apple with Apple Card. That's a sort of delivering credit, but it's mostly what we call a transactor card, right? So it's more of a payment product than credit product. I think there are a number of structural issues for technology companies to really get into credit, and if you don't get into credit, it's really hard to get into banking because credit is the monetization strategy. So I think it's going to be more sort of alliances than I think direct entries by these companies.
Oh, very clear. And another question is, can you tell us whether Upgrade is a typical platform that leverages network effects?
No and yes. So I think there are a lot of platform of sort of network effects, but it's not typical. So I think some of our network effects are like very specific to credit, and it has to do with cost of capital and credit quality. So as we sort of lower the cost of capital, so as we have like more data, better credit performance, so investors or loan buyers have a lower perception of risk. So because we're going to rely on a longer track record, because we have a lower perception of risk, their return target comes down. As the return target comes down, the cost of capital, so to speak, comes down. We can make loans at a lower rate. By making loans at a lower rate, we generate what we call positive selection on the credit side, with people with the best credit quality being sort of attracted to the lower rates, and people with better credit quality and who are more sort of aware of their credit and want to keep their credit standing as high as possible. They are less likely to default on their loans, and because they're less likely to default on their loans, the credit performance continues to improve, which sort of lowers the sort of risk perception from loan buyers, which gets us even lower risk, lower sort of cost capital. So there's a really sort of nice flying wheel, which is a bit different from platform effects in a traditional tech sense, but is nonetheless super helpful and very impactful.
Thank you very much, Renaud. We have two last questions and 1 minute, so perhaps go fast. The first one is, what are your predictions for the banking industry for 2023?
In the interest to go fast, I do not make predictions. I'm notoriously bad at making predictions, so I don't know. I think it's going to keep going on the current trends.
And so the last one, if you don't make predictions, perhaps you make wishes. So the last one is, what do you wish for the banking industry for the next year?
Yeah, so I mean, one of the current trends, I think will actually continue to be reinforced next year, and that I very much wish we continue to happen, is really continuing to see partnerships between sort of banks, traditional banks, and fintech companies. I think we're truly crafting sort of win-win partnerships with banks doing what they're good at, fintech companies focusing on what they're good at as well. I mean, banks have sort of large customer bases, sort of very deep user data pool that can be used to sort of refine the user experience. Fintech companies are generally good at product innovation and sort of delivering that experience. So there are a lot of alliances that can be formed, and banks can benefit by sort of earning higher returns. I mean, a lot of the banks that buy loans from us have found that they're making a higher ROI, return on asset, on the loans they're buying from us than the loan they originate directly, because of better performance, because of lower cost of delivering this product. So I think there are truly sort of win-win partnerships, and I'm very big proponent of people also focusing on what they do best. So I'm both predicting and hoping that these partnerships continue.
Thank you very much for these wishes, Renaud. It's been amazing having you with us, and I'm sure that European people that listen you less often share this with me. And thank you so much. It's been a real huge pleasure. It was insightful and inspiring. So thank you so much, Renaud, for your energy and your vision and the impact you're having in the US. I hope perhaps one day you will have it in Europe as well. Sylvia, if you want to conclude.
Yes, I think it's time to go. Completely agree that it was amazing. I want to thank you, Ania Chamsor, Thibaut Mounier, Nicolas Filatieff, Anne-Louise Costes, and aussi Renaud Laplanche. Oh yeah, sorry, I was jumping into French. And on the other side, our chairman, Jean-Marc, for this amazing webinar. Just a reminder that you will have this webinar available on our Qorus website. The recording will be available, let's say, from Monday, but only for members. Okay, so thank you again. See you soon, and I hope you have enjoyed. Bye-bye.
Thank you. Bye-bye.
Thank you very much. Thank you, everyone. Bye.